Hello, my name is Robin Wang, and I'm a capital advisor that is part of Prosper Portland's Inclusive Business Resource Network. And today we're going to talk about can you get a business loan? And we'll talk about some of the criterias for getting a business loan so that you can determine or get a kind of a sense if you and your business can qualify for a loan. So the agenda that we'll use today is we'll talk about 8 kind of key requirements of getting a business loan, and talk about some options. If you don't meet those requirements, what are some options that might be available to you for still getting a loan or getting capital in your business. And then we'll wrap up with a little bit about the capital advising services that we provide here and that you can take advantage of. So let's get started. So the first criteria for getting a loan is sufficient profits, and that's because profits are really what repays loans. If you don't have profit, you're not going to be able to repay a loan. So lenders will look for whether you have sufficient profits to repay the loan that you're seeking to borrow. And rule of thumb, and this changes from lender to lender, but just kind of rule of thumb, they want your profits to be about 120% more than your annual loan payments. And that's just to build in a little bit of buffer room, in case, profits don't go as according to plan. But, in essence, they want, your profits to be more than your loan payments. And minimally, they want to look at your historical profits because that's kind of, in the past. And if you're able to generate sufficient profits in the past, yeah, there's likely that you can generate profits in the future. Um, some lenders are willing to look at forecasted profits, particularly if you're a young business. Obviously, forecasted profits are not written in stone, and certainly a degree of risk associated with them. So some lenders will discount them, or some lenders will not use them at all. But some lenders are under the right circumstances, will be willing to consider your forecasted profits. But you're going to have to go in there with a pretty strong and solid forecast for that to happen. So what do you do if you don't have sufficient profits? There's a couple options. One is, forecast increased profits, and I don't mean, making up numbers, but tweaking your plans, honing in the numbers so that, you're able to generate more revenue and or lower your costs. And, that way you'll be able to show that you have, sufficient profits looking forward. Another option is to reduce loan size. Maybe you can't afford a $50,000 loan because your profits can't support it, but maybe you can support a $20,000, $30,000 loan. So, are you able to do, similar growth for your business with less capital? And then the third option is actually to seek a community lender. We'll talk more about this at the end because I refer to community lenders a lot in this presentation. But in essence, a community lender is a lender that is, not a bank. They're typically a nonprofit or government agency, and they have a motivation to help your business. They have a mission to help businesses, mission for economic development, and unlike a bank or a credit union, not necessarily profit driven. So we'll talk more about community lenders, but there are another pool of lenders out there that could help your business. The next criteria is they want to see ideally 2 or more years of business. Some lenders are willing to go as few as 1 year in the business, but they want to see a track record. And the track record is important because it demonstrates that you're a financially viable business. That you're operating, and especially if you're generating a profit, it's a viable business. They also want to see experienced management. If you've been at a business for 6 months, it's not clear that you're an experienced manager. Whereas if you're a business and have operated through various economic cycles successfully over 5, 10 years, they know that the experience, the management is experienced. So what can you do if you're too young? One is just wait it out. I know that can be painful, but you can just wait it out, right? Maybe you're 18 months in, wait for another 6 months, wait for another year when you have those 2 years of financials and track records. Another option is to seek a community lender. They will have oftentimes less stringent requirements around years in business. Some are even willing to lend to startups. Um, And then another option is you can consider a personal loan or a credit card. This is a loan that you, as a business owner, personally, not the business, personally take out. Whether it's a personal loan or a credit card loan, you take money in your personal out of your name, and then you transfer that money to your business. So you're investing, some of the borrowed funds into your business, but you personally are required to or responsible for those funds. Um, and because it's a personal loan, it's tied to you personally, and so they don't necessarily need to see the track record in business. That said, personal loans and credit cards will they'll allow you to get some capital, but typically it's not as much as you might be able to seek through a business loan. And we're talking 5, 10, maybe $20,000 in a personal loan or through your credit card. Um, but business loans, and they kind of tap out at that point, whereas business loans can go much bigger than that. Another thing that lenders want to see is, or conventional lenders, I should say, is a 680 or more credit score. Now, 680 is just a kind of a line in the sand. It's a general threshold. Some lenders will go lower, some lenders will require higher, but roughly they want to see a 680 or higher credit score. And that's because there's a high correlation between how one manages, the personal finances versus the business finances. If you're constantly delinquent with your personal finances, the law argument is that your chances are you're going to be delinquent with your business finances. But if have a perfect track record with your personal finances, then chances are your business finances will, follow the same path. For lenders, this credit score is also important because it's a very low cost, readily available assessment for lenders. They can kind of with almost at no cost get an assessment of your credit worthiness in a number or quantifiable fashion. So it's very easy for lenders to make a credit assessment using a credit score. So what can you do if your credit score is not high enough? A couple things is you can seek credit repair or counseling. These are services that can help you rebuild or fix your credit history. They don't necessarily fix your score, but they'll help you fix your credit history, which in turn will hopefully move your credit score up. Another option is to seek a community lender. Some lenders are willing to lend to significantly lower businesses where the owners have significantly lower credit scores. Another thing related is they don't want to see any adverse records. And by adverse records, primarily referring to, they don't want to see any recent bankruptcies or liens. Liens may be when a tax authority like the IRS or the state treasury or a lender might have a lien on your business or some assets on your business because you still owe them money. They don't want to see that on your credit records. So, what can you do if an adverse record exists? One, if it's a bankruptcy, wait it out. Unfortunately, that could be a while. Sometimes it could take as much as 7 years for a bankruptcy to leave your credit report. But if you're like, year 6 into it, you might be able to wait it out for a year, and at which point, the bankruptcy no longer shows on your credit history. Liens, the option is to repay the lien, repay the obligation that is causing the lien to be on your record. Another option is to refinance. I've done that in the past where, a borrower comes into us, they're seeking loans, they can't get a loan because they have a lien. So the first thing that we do is refinance the lien or refinance the debt that's associated with the lien. With the lien or with that debt paid off, the lien is removed, and it's one less adverse record that might exist on the profile. And then also, again, seek a community lender. They may be more flexible to work with liens or bankruptcies, given your particular situation. Another requirement is to have financial statements and tax returns. Financial statements, are really needed to assess the financial health of the business. And some businesses, particularly those that are young, may not have, a solid set of financial statements that they can provide to a lender or prospective lender, and therefore that lender can't, get an assessment. Is this business in good financial shape? Um, and then tax returns are just as important. For most businesses, your financials are not audited. It's very expensive to do an audit. But when you file a tax return, you're kind of making a pledge, a commitment to the IRS, that the numbers that you're providing are legit. And so it's some form of attestation that the financial statements that you're providing is accurate. So tax returns are often required for a to apply for a business loan. So what to do if they're not available? From a traditional lender, it's going to be very difficult to get a business loan if you don't have financial statements and or tax returns. So you can also consider getting a personal loan or a credit card where this information is often not needed for a loan. But again, the amount of capital that you can access is probably a little bit smaller. Another thing is to get into the practice of regular bookkeeping. Get your financial statements in order. Do regular bookkeeping, whether it's hiring a service to do that or learning how to do that on your own. There are lots of resources in Prosper Portland's Inclusive Business Resource Network that can help you with the bookkeeping. So I would encourage you to take a look at them and see if some of those can help your situation if you don't have accurate financial reports at this time. And then finally, again, seek a community lender. Sometimes they're willing to, look at your bank statements and reconstruct a financial statement, based upon that. Or they can make, they don't necessarily require a high degree of sophistication or accuracy in the financial statements when they do their underwriting or their loan reviews. So they're willing to work with, potentially less accurate information. So community lenders are an option if you don't have or are not able to provide financial statements and tax returns. Next is collateral. Collateral is an asset that you pledge to the lender in the event that you can't repay the loan. In which case, you're saying, okay, if I can't repay the loan, you can have this asset, you can have this collateral that I'm pledging. You can resell it, liquidate it, and use the proceeds to repay the loan. So, most small business loans will require some type of collateral, as I said, as a backup form of repayment. And the collateral can be other business assets, so it could be vehicles, equipment, inventory, or it can be personal assets. It could be a piece of jewelry or something that is a house or something that is valuable. Different lenders will have different collateral requirements. Some lenders may not work with certain types of collaterals, others will. That's obviously their prerogative. But what's important to any lender is that the liquidation value of the asset is typically, again, rule of thumb, 120% more than the loan principal. So if you're asking for a $10,000 loan, they want something that collateral that you pledge that is worth $12,000 when that asset is liquidated, or if that asset had to be liquidated. So liquidation value, keep in mind, is not necessarily market value. Liquidation value is the value that they would get if that asset had to be auctioned off, because that's often how assets are liquidated. And so auctions often don't command the best price. And then plus there's lots of fees associated with liquidating an asset. And so that is deducted from the sale value and thus the liquidation value. So yeah, the liquidation value has to be more than the loan principal. If you are getting an equipment loan or a real estate loan, the nice thing about those type of loans is that that loan payment can be, or loan purchase can be collateral. If you're getting a piece of equipment or a vehicle, you can pledge that collateral, that item that you're purchasing as collateral for that loan. So you don't need other, or you don't need to involve other assets, whether it's in your business or your personal assets in the loan. So what can you do if you don't have sufficient collateral? One is reduce the loan value. Maybe you have maybe you have collateral, it's just not worth as much. So you can reduce the value of the loan to meet the liquidation value requirements. You can get, additional collateral pledges. And, sometimes there might be, friends, family, other organizations that, might be interested in supporting you. And they're willing to pledge some collateral or assets as collateral to your loan. So, look around, ask around your network, maybe they're willing to do that. You can also pursue loan guarantees, and this is often done with many loans when there is insufficient collateral. And a loan guarantee is essentially a third party that's going to say, hey, if you can't repay this loan, we're going to guarantee this loan, or at least a large portion of it. And in fact, the federal government through the SBA has a very robust loan guarantee program, and uh, providing, the loan guarantees when there's insufficient collateral is a key reason why this program exists. So there's a lot of loans out there to businesses that don't have sufficient collateral, but the SBA is willing to guarantee the loan so that the lender can be made whole or largely whole, in the event that loan defaults. So definitely talk to your prospective lender about loan guarantees and see what programs they may have access, to them. And once again, you can talk to community lenders. They often have much lower collateral requirements. Some don't require collateral at all. Some also work with the loan guarantee programs or a mix and match of, different types of incentives and programs out there. So, they're definitely a option that you can consider. Now, this might sound a little corny, but you really need a plan. The worst thing you can go is to go to a lender and they ask you, how much do you need and what do you need it for? And it says, I just need to grow my business and I'll take whatever you can give me. That's the worst answer to give. They want a plan. They want to understand how you're going to use the funds, so it's the use of funds. And ideally, they want to see a repayment plan, a forecast. And they may dictate one, but that shows to them that you've done your homework, that, you're seeking a $20,000 loan, to purchase a piece of equipment, that's going to allow you to grow your revenues. That growth of revenues is going to allow you to generate sufficient profits to repay the loan. That's the plan. They want to see how you're going to use the funds and how you're going to repay the funds. You don't need, it doesn't have to be a sophisticated plan. It could be, something that's in a spreadsheet or on a one pager, but they just want you to, think about it. So what if you don't have a plan? My advice is, if you're working with the Prosper Portland's Inclusive Business Resource Business Network, IBRN, work with an advisor. There are advisors solely for this purpose out there. Work with an advisor to develop a plan. And I highly recommend that is the approach that you go with. But if for whatever reason you are not able to put a plan or you don't want to put in a plan, then your other option is again to get a personal loan or a credit card. This is again a loan that you're personally responsible for. The lender doesn't really care what you use it for, or typically doesn't care, so you can put the money in your business, but you're personally responsible for that. You'll see intentionally missing is community lenders, because community lenders will, want to see a plan, but some of them may be willing to work with you and help you, develop a plan. So, really come up with a plan for why you want a loan. Another requirement is a personal guarantee. And the primary reason is that, lenders want the owner or owners, in the event that there's more than one, to have some skin in the game, that, you're making decisions, for the business, and to, to repay the loan. And, if you don't have any skin in the game, you might be making decisions for the business that are not in the best interest of the loan. So what a personal guarantee means is that, if the business is not able to repay the loan, that the owner or owners will step in and repay the loan. So that way, you as an owner have some skin in the game. And it represents a, backup repayment means. So what to do if you don't want to pledge a personal guarantee? Unfortunately, you really don't have an option. All business loans are going to require a personal guarantee. Now, the difference is what the lender may do with a personal guarantee. Um, Conventional bank lenders, they're probably going to enforce the personal guarantee. So if your business is not able to repay the loan, that loan is now that's your personal liability, and they're going to require that you make personal payments to fulfill that loan. Whereas a community lender, depending on the circumstances, they may not require you to make a personal monthly payments or enter into a payment plan with your personal funds, but they want to kind of just keep you engaged. Maybe there's other opportunities or other ways to do so. And some of them view a personal guarantee as a way to just kind of keep you engaged in the process, if the loan, doesn't go as planned. Again, each community lender is going to be different, and how they approach personal guarantees will be different. But they tend to be a little bit more lenient with the personal guarantee than a more traditional bank with their personal guarantees. So I talked a lot about community lenders, and so let me take a moment here to explain who they are and what they do. As I briefly said earlier, community lenders, they lend for a mission, not for a profit. Banks typically lend for a profit, whereas community lenders, which are typically nonprofits or public agencies, they want to provide lending for a mission to help a particular community, help a particular population, to spur or enable economic development in a certain region of the city or a certain region or certain industry. So because they're lending for a mission, they're a little bit more flexible with their underwriting and with how they service the loan. And so with that flexibility, they're often able to make loans. I shouldn't say often. They're sometimes able to make loans that bankers or traditional banks will not lend to. Um, the drawback with community lenders is that the available capital is relatively very limited. Whereas banks have access to billions and billions of dollars for lending, um, community lenders, is probably 1 or 2% of that pool. So their money is much less available. It's there for a purpose, it's there for a mission, but there's not that much of it out there relative to what banks have access to. So keep that in mind as you're looking for community lenders. Um, some of the Portland area community lenders, the nonprofit lenders include MISO, Craft 3, Business Impact Northwest, and Mercy Corps Northwest. Some of the government lenders that operate in the Portland area are Prosper Portland and Business Oregon. There's also some other kind of niche lenders out there, but this group of 6 or 7 lenders, they make up the bulk of the community lenders that operate in the Portland region. Um, the last thing I want to say is just a word of caution about 48-hour lenders. I'm sure you've seen those offers. They come by email or mail, and they say, get approved in 48 hours. And for some organizations that need capital, it could be very enticing to get approved or get a loan in 48 hours. And they can, because they have a very different business model when it comes to lending, they can often provide capital for many challenging situations. So for some of the scenarios that we mentioned earlier, if you don't meet those criteria or those requirements, some of these 48-hour lenders can provide capital, in those situations. However, there's a couple of drawbacks. They're very expensive and onerous. I've seen examples where you borrow $10,000 and you're required to repay the loan in 1 year, but the amount that you have to repay is $18,000. That's 80% interest. So that's a huge premium that you're paying to get $10,000 upfront. And by paying that much money, they can accept the fact that they may lose some loans, but they're making up for the fact that they're asking their borrowers to pay a huge amount of money for the loans that they take out. Another thing that many of these 48-hour lenders will require are daily and automatic withdrawals. Every single business day, they're going to take money out of your bank account. Now, it's going to be a relatively small amount. It might be, oh, yeah, we'll just take out $25 a day from your bank account. And you might think, oh, $25 a day, not a big deal. But $25 a day, each day, that adds up over the course of the month. I can't do the math off the top of my head, but you can do it on your calculator. That's a nice hunk of change. And especially if you're in your dry season or slow season, every business has, seasons where, there's more revenue and less revenue. And during the dry season, when there isn't that much revenue, $25 a day for every day of the month could put a tremendous cash flow burden on your business. I've met a lot of business owners who find themselves in that situation, and they stop running their business. Instead, they're all focused every single day, every single hour, focused on how they can get enough money to make that next, to cover that next withdrawal that will come up in the next 24 hours. So it can be very onerous and demanding and not a pleasant situation for a business owner to be in. And then finally, you can't repay early. Most banks, if you repay early, you save the interest because you're not borrowing from them. But using the example earlier, if you were to borrow $10,000, if your business landed the huge contract the next day and was able to had enough cash to repay the loan right away, you're required to pay them $18,000. Not $10,000 plus 1 day of interest. So there are penalties, or there's no incentive to repay early. So the bottom line is, if this is a loan that you're going to consider, do your homework. Analyze the payment schedule, scrutinize it, make sure that that's something that you're comfortable working on and supporting, and don't make generous assumptions on your part. Think worst case scenario, because that worst case scenario is going to create a lot of headaches and pain for you if that happens. And most definitely read the fine print. Each of these loans vary. You need to read the fine print to really understand what you're getting into, if you go after these loans. So that's kind of all I had to say about some of the requirements. I want to take a few moments to wrap it up by talking a little bit about the capital advising that is offered through Prosper Portland's IBRN network, and these are services that I am able to provide if you're seeking a loan. In a nutshell, we provide a variety of support to businesses that might be seeking capital. Starting with planning. I'm available to help, with your planning, to give you guidance to determine your needs and use of funds. How much money do you need? What are you going to use the money for? I can provide guidance on that. Give you guidance on what type of loan makes most sense for you. What's the terms? Is it a line of credit? Is it a term loan? What are some other the criteria of the loan? Helping you do, some forecasting so you can see if you're able to repay the loan, and see if the impact of the loan is sufficient to meet, your goals and objectives, as well as a loan readiness assessment. It's essentially kind of what we just talked about in this video, but on a one-on-one basis, so you can, get a sense, if you can get a business loan or not. Next, if you decide to pursue a loan, we can help you shop around for a loan. Identifying some of the appropriate lenders that might be a good fit for what you're trying to do in your situation. I can make referrals to some lenders, particularly the community lenders that are out there, and support you as you're having those initial conversations with those lenders. If you decide to apply, we can provide a lot of support around loan packaging and guidance. Help you prepare and refine the plans, reports, forecasts, whatever is required as part of the loan application package. Answering sometimes difficult questions. There might be questions they ask, and given your situation, or it might be a little bit difficult to answer without jeopardizing your ability to secure the loan. So I can help you navigate through some questions that the lender might be asking you during the application process. And then finally, just reviewing everything right before you submit to make sure that to maximize the chances of you, getting approved for the loan. And then finally, if you're approved for the loan, can help you in the pros and process, reviewing and summarizing the loan terms to make sure that you understand, not in legalese, but you understand, what you're committed to do to satisfy the conditions of the loan, and provide you guidance, if there's an opportunity to negotiate your loan, the terms of the loan, or the timing of your loan. So, really there is a support as you're, closing everything out. So, if you're interested in, your capital advising session, and if you're an eligible business operating in the Portland area, the capital advising session can be provided, free of charge. And you can go to this link, or scan it. The same brings you to the same place, and schedule your capital advising session with me. And we'll kind of go over on a one-on-one basis, whatever questions that you may have, and help you move forward in your loan application, or kind of loan consideration process. So that's it. Thank you for attending and or sitting in this video, and we look forward to helping you out in the days and months to come. Thank you.